If you're a business owner over 73 or approaching it, there's a major financial hit waiting for you if you're not proactive. It's called RMD tax exposure, required minimum distributions. And if you think it's just another retirement rule, think again. This is about preserving your wealth, keeping more of what you built, and exiting smart. Let's break it down, step by step, fact by fact. RMDs are mandatory withdrawals from tax-deferred retirement accounts, like traditional IRAs, SEP IRAs, and 401ks. The IRS requires you to start these withdrawals by April 1st of the year after you turn 73. Here's the problem. These withdrawals are taxed as ordinary income. So even if you don't need the money, the government will force you to take it and tax it. As of 2025, the IRS Uniform Lifetime Table determines your RMD amount based on your age and account balance from the previous year. For example, if you have $1.5 million in a traditional IRA at age 73, your RMD could be around $56,000 annually, depending on the divisor. That's $56,000 added to your taxable income, and it may push you into a higher tax bracket, affect your Medicare premiums, and reduce Social Security benefits. According to Fidelity, the average 401k balance for those aged 65 and older is about $232,000, but many business owners have portfolios well above that. This makes RMD taxes even more damaging. Here's what most people miss. RMDs don't care if you're still working, semi-retired, or fully retired. Once you're 73, you're on the clock. That's why tax planning before RMD start is non-negotiable. Let's get into tactical strategies you can start using now. 1. Roth conversions before age 73. This is one of the most powerful tools. Converting a portion of your traditional IRA to a Roth IRA before age 73 means paying taxes now at potentially lower rates and avoiding RMDs from those funds later. Why it works? Roth IRAs don't have RMDs. Future growth is tax-free. You reduce the balance subject to RMD rules. Data point. According to Vanguard, Roth conversions in early retirement, especially before age 73, can reduce lifetime tax bills by hundreds of thousands of dollars for high-income retirees. 2. Qualified charitable distributions, QCDs. If you're 70 and a half or older, you can transfer up to $100,000 annually from your IRA directly to a qualified charity, and that amount is excluded from your taxable income. Why it matters. Satisfies your RMD requirement. Doesn't increase your adjusted gross income, AGI. Helps avoid Medicare IRMAA surcharges. For high-income retirees, this is one of the cleanest tax shields available today. 3. Delay Social Security to control AGI. Taking Social Security early raises your AGI, which can compound the tax hit from RMDs. Delaying until age 70 increases your benefits and keeps AGI lower during key Roth conversion years. Fact. Each year you delay past full retirement age, your Social Security increases by approximately 8% annually. This gives you more room to execute Roth conversions or capital gains harvesting without hitting higher tax brackets. 4. Optimize asset location. Make sure you're putting the right types of investments in the right accounts. Tax-inefficient assets, like bonds, REITs, should go in tax-deferred accounts. Tax-efficient or growth assets, like index funds, can sit in Roth accounts for long-term compounding. This reduces your tax drag and lowers RMD growth. Source. Morningstar data shows that asset location strategies can increase retirement portfolio efficiency by up to 20% over a 30-year horizon. 5. Use the still working exception strategically. If you're over 73 but still working and don't own more than 5% of your company, you can delay RMDs from your current employer's 401k. This doesn't apply to IRAs, but it can be a game changer if you plan to work into your 70s. Consider rolling previous 401ks into your current employer's plan to delay withdrawals even 5. Use the still working exception strategically. If you're over 73 but still working and don't own more than 5% of your company, you can delay RMDs from your current employer's 401k. This doesn't apply to IRAs, but it can be a game changer if you plan to work into your 70s. Consider rolling previous 401ks into your current employer's plan to delay withdrawals even further. 6. Consider partial withdrawals before 73. If you're in a low tax bracket now, consider taking controlled withdrawals from your IRA before age 73, even if you don't need the money. This allows you to spread out taxable income and reduce large RMDs later. It's called bracket filling, and it's especially effective if you retire before Social Security kicks in. 7. Leverage annuities to control RMD exposure. Certain annuity products, like qualified longevity annuity contracts, QLACs, allow you to defer a portion of your RMDs until age 85. Current rules. As of 2024, you can invest up to $200,000 in a QLAC from your IRA, deferring taxes and reducing RMD amounts. This is useful for those who want guaranteed income later in life, while shrinking their taxable footprint today. Don't wait until you're 73. By then, your options are limited. Don't assume your CPA is managing this proactively. Many tax professionals focus on annual filings, not long-term withdrawal planning. Don't treat all retirement accounts the same. IRAs and 401ks are taxed differently in estate transfers, withdrawals, and conversions. Don't ignore Medicare thresholds. RMDs can push you into IRMAA surcharges, increasing your Medicare premiums by thousands per year. Don't DIY complex conversions. Missteps in Roth conversions or QCDs can trigger unwanted penalties or double taxation. Here's what smart business owners are doing right now: running multi-year tax projections to simulate income, RMDs, and Roth conversion windows. Meeting with a fiduciary financial advisor, specifically one who understands exit planning, not just investment returns. Reviewing asset allocations to position for tax efficiency, not just performance. Setting a strategy before 73, because tax rules are rigid, but timing is everything. Exploring estate transfer strategies, since RMDs affect not only your taxes, but also what your heirs will receive. Retirement isn't just about withdrawing money. It's about withdrawing wisely. Shrink your RMD tax hit. Build a smarter exit strategy. And keep more of what you've earned, because you didn't build your empire to give half of it to the IRS.